Hello class, today I will present my final project and I hope you like it. To start off, I will outline what my duties will be as a managerial accountant in the company. So I can help in improving the company's operations and sustainability through the implementation of budgets, planning, controlling measures, and also by getting involved in the decision-making process. In regards to budgets, these are very useful in determining the expenses that will arise in the future terms, for which they have to be made as accurate as possible. My role here would basically consist in looking at past data and use this information to create budgets on future sales, the cost of materials, the cost of labor, and others. When it comes to the treatment of our resources, we have to be very cautious on this because these are limited, and for this reason, we must identify the needs of each department and split our resources wisely. Moving forward, I will apply control measures over budgets. In fact, it's not only about implementing budgets, but we have to control them and ensure that these are being followed. And lastly, I can also get involved in the decision making process due to my knowledge on budgets. For example, I can use information on forecasts to find a benchmark over the selling prices, and I can also use other strategies to pursue more profits, as for example, defining whether it would be more profitable to outsource or also if we should process our goods into others to generate more profit. Now, talking about the types of costs that may arise in a bakery, we have to separate this between the fixed, variable, and mixed costs. In regards to fixed costs, these remain constant regardless of any change in activity level. For example, if the demand of bread increases, the fixed costs will not be influenced by this change. Some major fixed costs that we can find in a bakery are, for example, the rent expense, the property taxes. This example in particular depends on the leasing contract. We can also consider the wage expenses, the depreciation of equipment, as this has a linear depreciation over time, and also other consistent utilities such as water, phones, or computer lines. Uh, we have also the variable costs, which are those that vary in accordance to changes in activity level. Some examples are the ingredients used in production, as the amount bought will eventually change depending on whether the demand for bread is high or low, and similarly with supplies and packaging materials. Other variable costs that can be the extra wage hours for employees that work beyond their regular schedule. Finally, we have the mixed costs, which have components of both fixed and variable expenses. For example, the maintenance of equipment can be considered a mixed cost because it has a fixed component, which is the maintenance payments that have to be made periodically, and it also has a variable component, which are these spare parts, as these are bought whenever the machines need a replacement. Among other costs, we also have the direct labor, direct materials, and manufacturing overhead. In regards to the direct labor, this refers to any person explicitly involved in the production process, and within a bakery, it would basically be all the bakers involved in preparing the baked goods. When it comes to direct materials, similarly, these are all the materials directly involved in the production process, and in a bakery, this would be the sugar, the butter, the grains, the wheat flour, and etc. Finally, the manufacturing overhead are all the indirect manufacturing costs. Even though these costs are related to the goods produced, they cannot be directly traceable. Some examples are the indirect labor, such as, for example, the cashier at the bakery, those who verify the quality of the baked products, and it could also be the cleaning staff of the store. and the main indirect material would be the machinery or the machines used to prepare the bread, such as the ovens, the mixers, the fixers, and others. Talking about the costing methods, a bakery should definitely rely on the job costing method because it sells multiple products such as sandwiches, donuts, cookies, and each of these represent a different production cost, and therefore they have to be treated differently when they are registered in the accounting records. In fact, the only situation in which a company can employ the process costing method is when they sell a single product that is indistinguishable when it comes to their production costs. Also, the job costing method implies the creation of job costing sheets every time an order is placed by a client. Uh, I provided here an example in where a client orders a dozen donuts. So what the bakery should do is to outline the costs of materials used, the cost of labor hours, and the MOH, and then add all of this up in order to find out the total production cost for this specific order. For this slide, I made a schedule of cost of goods manufactured with realistic amounts that could possibly arise in a bakery. The goal of this is to find the total cost of goods manufactured for the term ended on the 31st of October. To start off, we must first find the raw materials employed during the month of October, which, as I explained before, are all of those materials explicitly used for producing the baked products, such as the butter, the grains, the sugar, etc. Then we add the direct labor expenses for the month, and here we have to look closely at the wage rate that each employee is given because this can change depending on the complexity of their tasks. For example, those employees that are in charge of designing cakes will have a higher wage due to their specialized abilities, while those engaged in less complex tasks, such as mixing or baking, will perceive a lower salary. Then we add to this number we add the MOH expense, which are those indirect expenses attached to production, such as the cost of running the machines. And once we have encountered the total manufacturing cost, we add the beginning working process, which is the residual value from the previous term, and we subtract the ending working process, which is the residual value from this term, and as a result, we get the cost of goods sold, which is $33,000. The break-even point is where our total revenue intersects our total costs, and at this point, we have neither gains nor losses, but we have recovered our expenses. Our role here is to determine how many units we would have to sell in order to reach this point, and here I provided an example using realistic figures that can happen in our bakery. The formula consists in dividing our fixed costs of $15,000 by our contribution margin per unit of $3. Uh, and this tells us that we have to sell 7,500 cakes in order to break even and recoup our fixed expenses. Also, if we want to enter into the profitable area, we would have to sell more than this amount, and at the same time, selling less will create losses for the company. Talking about the sales budget, this basically outlines how many units are expected to be sold during the upcoming term. Also, we consider this budget as the origin from which all the other budgets develop. For instance, the production department of the bakery will rely on the projected sales given by the sales department in order to buy their materials in accordance. Moreover, we're also required to make a cash collection which measures the inflows of cash during each quarter. In this example, the bakery receives 70% of the transaction in the same quarter, and the rest in the following. And this usually happens because customers can pay in credit, which involves giving an upfront payment and depositing the rest afterwards. Using the context of bakeries, bakeries usually allow their more consistent clients to buy products in credit, giving them the possibility to pay for them at the end of the month. A tool that is commonly used to determine whether a business performed well or not is the variance analysis. And this consists in finding the difference between our initial budget and the actual results accomplished at the end of the term. The role of managers is to inquire about the possible reasons behind these changes and identify if they have brought positive or negative effects. A bakery is a business involved in massive production, and therefore it has to look at significant changes in quantity, prices, and labor, as any of these changes could possibly influence the company's profitability. Here I provided two variances analyses, and the first looks at materials. As you can see, the bakery forecasted that the materials used over the term were going to be 2,800 pounds, but this went beyond to 3,000 pounds, and this change might have been due to an increase in the demand for bread. It is also important to mention that businesses that deal with food have to be careful when buying their ingredients, as these have expiration dates, and if they order more ingredients than needed, this will be stored for a while, and they can possibly expire. Also, on the other side, if the bakery orders less materials than actually needed, they could lose some sales. I also provided an example that displays the labor efficiency variance, which measures the length of time in which production is completed. As we can see, the bakery took 100 hours more than expected to complete production, and some reasons could possibly be the poorly trained workers, or maybe a machine or an oven or a mixer broke down and that paralyzed production for a moment. Once the bakery has settled in the market and gained recognition, it can begin thinking about investments and the extension of their operations. For example, they can invest in new machines, the opening of new locals, and innovations. In order to measure whether the investment will be worth it or not, the bakery can use different methods, such as the net present value, the internal rate of return, and the payback method. Although all of these methods are very effective in complying with their purpose, I would go with the net present value because this is the most complete in the sense that it measures all the possible cash flows. It takes into consideration the time value of money, and it basically tells us the well added to our initial investments. In the other side, the internal rate of return measures the return rate required to break even, while the payback method measures the time length that is needed to recoup our investment, and these two do not apply the time value concept. Here I provided an example, which is an investment on buying new machines, and I applied a net present method to see if the investment is valuable or not. As we can see, all the cash flows are added up, and we get a net present value of $1,437. And since that value is greater than zero, we have to accept the project because it means that it will be beneficial for the bakery. And here we would be discarding the discount rate, which is the opportunity cost that we're giving up.